because there are two myths that commonly exist with ESG or with trying to mainstream ESG. The first one is that I must suffer or I must compromise on my finance return in order to achieve impact. So I really do think that is a myth. Probably you can unbundle that a little bit better. The second one is, okay, I can use that as a risk mitigation. But for an investor, that alone is not sexy enough. Maybe in a volatile market, it is still sexy, but they are chasing alpha. So how can you demonstrate that through ESG integration, you can generate alpha? So, I mean, that's the set of data I think that people are looking for. What's your take on those two myths, Jason?
I think to answer your question, there are two different perspectives that I would like to share. My first perspective is that if you look at the use cases, there are brand awareness driven use case of ESG. Primarily, some of the fund managers want to declare their fund is more green, so that there's more retail or high net worth individuals buying their funds. There's also a purpose to fulfill their fund mandate. For example, a fund's LP might be asking their general partners to adopt ESG measures when they invest. There's also risk metrics where they want to avoid, they think ESG is a good factor to help them avoid certain types of risks. And there's also a return kind of a perspective. Where I see the market is driven is that increasingly, as more and more capital focuses on ESG, the capital flow will eventually drive the market to be more ESG efficient.